Toronto mortgage rate delinquencies soar 71%. That means 71% people are now late on their mortgage payment and they're totally delinquent. What does this mean for the real estate market? We'll be talking about this article, plus one more that kind of ties right in, which is a great headline that says, "Forget rate relief, most Canadians are about to see their mortgage payments soar." What on earth is happening? I thought we were all expecting rate cuts, right? This is exactly what I'll be breaking down for you on this week's reaction video. Now, if you're looking for some help on how to navigate this real estate market, whether you have a renewal that's coming up or you're just kind of concerned about, your mortgage and you want to chat about what's going on after you see this video, you could do so by booking a call with me using a link that's on the screen. It's right here. It's www.chatwithzen.com. Simply click on the date and a time that works best for you. And then when you see the prompt, fill in your name, email, mobile phone number, and the question you have for me, and then we'll chat then. Good day, Toronto. Welcome to another episode of Prime Properties TV. My name is Zhen, and if you're enjoying the content I'm putting out there, do me a solid and like and subscribe. So the first article we'll be covering is Toronto mortgage delinquency rates surge 71%. Dun, 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 dun. Is it really that big of a deal? I mean, if we look at the chart, you can see right here, it goes like 0.06%. You go from here all the way to here. So obviously that is a 71% increase, which, not that bad. But when you kind of go back in time all the way to like, say, Q4 2016, it's just the first time that it's past that, 0.14%, which honestly is really not that bad. And that's kind of why I think this headline's a little bit clickbaity. But I will say, during this period, these were the boom times and things were great. But now we may not be in a boom time. And this is probably a sign, right? That, there's probably going to be more delinquencies to come. So I would not be surprised if we see another article like this sometime in like maybe the next few quarters where it says it's over 100%, right? I do expect to have more delinquencies as people are going to renewal. But at the moment right now, this is kind of normal. Now, when I pull up some of the data we have from ourselves, we looked at this, it's pretty much spot on, identical. You can see this one's from the 2020 numbers. The one from this article goes all the way back to 2015, right? So ours was here. So it's pretty comparable. This is just data from CMHC. So is this a concern? No. Is this a warning sign? Yes. Can things get worse if the rate environment doesn't change? Absolutely. And I can definitely see more delinquencies happening. It's just the magic question that everyone asks is this enough delinquencies to move the market? Yeah, no, I don't think so. To give you an idea of the gravity of this, not from a percentage, but from like a nominal amount, at 0.12%, it's roughly like 1 in 850 mortgages are delinquent, right? At 0.06, it's like 1 in 1,600, right? So it's not a large amount. Like if you imagine, these entire condo complexes that are there, like each condo on like investor driven kind of units, I call it 400 units. That means in 4 condo towers, there's 1 delinquent mortgage back in 2022. And now in 2024, there's 2, right? So like the gravity of it is not that big. So just to illustrate that as an example, it's just the percentage, the rate of change, right, is very high. And that's kind of why it's catching a lot of headlines. Now, the second article that ties into this is the "Forget rate relief, most Canadians are about to see their mortgage interest rates soar." So what's happening right now is everyone's waiting for this interest rate cut. And I think this article illustrates one of my concerns that I don't think this interest rate cut is going to move the needle. It really isn't, right? And I'll show you exactly why shortly. So one of the things that I've highlighted here is the vast majority of existing mortgage borrowers, roughly 70%, have fixed rates that remain at record low prices available during the pandemic. For example, the lowest 5-year fixed mortgage was 1.39%, which compared to the 4.79%. So I think there's a little bit of mislabeling here. I think this number is correct. But when you look at the data here of the outstanding mortgage debt, which is like what debt's out there in Canada, you can see that it's not 70% that they're saying that that's at record low prices during the pandemic. I would say 70% is probably the combination of the 5-year fix over here, the 3 to 4 year fix, and the 1 to 2 year fix. When you add this, it's like roughly 7%. So if you do the math, 2024 minus 5 years, that gets you to 2019. The pandemic happened in 2020, right? I mean, that's my math. So I don't think these 5-year fixes are the ones that are renewing at the low pandemic rates. It's the ones that were in 2019 where the mortgage rates were 3%. So these are the ones that's coming up. The thing that I think this article is illustrating is that the 5 years of this, the 37%, make up a majority share of that's coming. So we're going to have the biggest cohort of renewals that are happening. But the rate of change is not going to be that bad. We're going from 3% to like 5%. Still like almost double, right? But it won't be as bad as when we're in 2025, like late 2025 and 2026, where we're doing that 1.39% to whatever it is in that time. And even if it's, say, at 4%, that's still a larger magnitude than currently right now from 3 to 5, right? But if interest rates become 3% again, that's the same magnitude and even a lesser amount. And then this whole mortgage renewal wall becomes a nothing burger, right? But again, no one knows where rates are going to be in 2025, 2026, right? So something to look up for. But let's assume the Bank of Canada cuts rates 3 times by the end of this year, totaling a decrease of 0.75 or 75 basis points. This will immediately lower the rates for variable mortgage holders, as those rates are directly impacted by central bank rates. And I've been trying to explain this to a lot of people who think that, when you get a Bank of Canada rate cut, that they're going to be buying with less. And I'm explaining this to sellers. No, the buyers are buying with fixed rates right now, which is 5%. So if you kind of look at this chart I have open over here, you can essentially see that this is the variable. When Bank of Canada does the cut, this thing will come down, right? This is like 6.2 right now. It will come down to, if you cut it another quarter, it will come down to 5.9. Buyers are buying with 5 point something right now, right? This one looks like it's a little bit below 4, so 4.8, right? So even if the variable drops, it's not like the buyers are changing their affordability. It's the same thing, right? It's just only thing that may change is the sentiment, right? Because start of the year, everyone was like, oh, 5 rate cuts, 5 rate cuts, 5 rate cuts. Now we're like down to 2, right? So you can kind of see over here, this was the implied rate cut policy. It keeps changing. Back in January, we were like looking at a line down here. In March, we're like, okay, we'll get 3 rate cuts, right? So we're at 5% right now. We go down 1, they call it June, right? Which is still expected. You go down another one in September, you go down another one in December. That's what the market was pricing in. And now that we're getting, call it, inflation data that we don't like, all of a sudden, we're not getting that last one towards the end, right? So this is what I mean. Like, I don't think this rate cut's going to save anybody, because if you go a variable and you cut it by 0.5%, it goes down to here. The fixed rate, which is tied to the bond market, is forward-looking. It's already at the 5s, right? So I don't think it's going to change the market significantly too much, even though we're going to have a bank rate cut. What I do think is it's going to encourage the buyers to be like, okay, we're done cutting rates right now. So maybe they'll feel more comfortable getting into the market, because right now everyone's at edge because they're like, uh-oh, the market hasn't moved. Sales are slow right now. This is probably one of the slowest March and April we've had outside of last year. And everyone's like, yeesh. And things are slowing down. We ramped up in January and February, and we're slowing down in March and April, which is spring, which is very abnormal, right? So this is what I'm saying. Even if you have a rate cut, it's not going to make a difference. And there's this chart I pulled up over here. This is showing you the origination of mortgage types, meaning what people are getting when they go get a mortgage, right? So you can see at the start of the year a little bit, if you look at the blue line, you can see, look, people are ramping up the variable, right? They're like, oh yeah, cool. Bank of Canada cut the rates. I'll do a 5-year variable, 6.2. They cut it by 150 bips. Oh, sick. I'm going to get it down to 4 point something, 4.7, right? I'm like, sweet. I'm definitely not taking a 3-year variable at 5% right now. And then all of a sudden, rates aren't coming. Okay, everyone stops getting the variable, right? When you apply this to the 3-year fixed, which is kind of like the cheapest rate you have without extending to 5 years, like, look, people are getting it. Oh no, maybe I'm not going to get it. And then people start getting it again. And it's the same thing in the gray end. People are going more with the constant because they don't know where these rate cuts are. And if you're wondering, hey, why are these people buying a mortgage? Don't they know the market's going to crash? Yada, yada, yada. Well, understand that a mortgage origination also includes people renewing. And a lot of people have to move and, get bigger spaces or downsizes. Someone passes, someone divorces. Like, life moves on. Just because, interest rates aren't moving around, the market may be semi-dead, like life still moves and people have to make that move regardless of what the market interest rates are, right? So this is kind of the sentiment that we're kind of looking at right now. And that's kind of why my thinking is that, and I agree with this, look, we're going to have some kind of relief in the future. So anyone holding a variable, your cash flow will get better, your payments will go down a little bit, but it's really not that bad. Now, the one thing I will kind of bring your attention to is the variable with static payment. This is the negative amortizing trigger rate kind of stuff we're talking about like for the last 12, maybe 18 months now. So it makes up 22% of that. And if I were to bring this into the fixed rate where people are going to get a payment shock, it's a pretty large amount, right? So you got 22 plus 57 plus this one plus that one. So essentially looking at over 80% of the people, if they renew, if rates stay this high, we're going to be in trouble, right? So that's why I'm saying the renewals may still have some issues. We're getting a big bulk of it right now, but the rate increase isn't that dramatic. The rate increases will get very dramatic in 26 and 27, but what will the rates be at that time? Nobody knows, right? Nobody knows. So this part is quite interesting. So based on CMHC data of the $2 trillion outstanding mortgage, we had 5% have to renew in 2023. Obviously, we survived that, not a big problem. And we have 13%, so almost 3x, a little bit like maybe 2.7x slated for this year. And again, rates haven't moved. They're kind of the same thing as last year. We're going to see how much inventory we're going to get from this if rates don't come down. And then that goes up to 23% in 2025, and then another 31% in 2026. Because that's essentially like when rates were low, everybody renewed to get a lower rate, right? So the timeline for the majority, like the bulk of mortgages is still coming later on. We're just going to see this number increase and increase. The magnitude and the severity of how badly it's going to be really just depends on what the rates are at the time of renewal. And like if we're talking about rate cuts right now, which by the way, not everyone's talking about rate cuts. Some people talk about rate hikes. But if we are to be having rate cuts this year, it should probably reduce the magnitude of it. But the question is just what the magnitude is and what the timing of your mortgage when it comes up for renewal is essentially going to be, right? Hopefully this gives you an idea of what's happening in the mortgage market right now and how that kind of impacts the real estate market. And these are just generally what people are thinking. I think really just depending on, what you're trying to do in the real estate market and what you're transacting on, you'll want to hear what you want to hear. So sellers want to hear rate cuts so that prices are coming up. Buyers want to hear rate cuts so that, maybe they get lower rates, or they may, hey, maybe I want to hear rate increases so that, sellers have to sell at a lower price, right? And so much of it really depends on where you're looking at, as I've been saying for a very, very long time, right? So in short, I would say, yes, delinquencies are up and they'll continue going up. Number two, yes, a lot of people are going to get mortgage renewal payment shocks, and that'll continue this year. And the thirdly is, yes, we're going to get rate cuts, but that rate cut that's coming may not save the market that everyone's thinking. That's kind of my thought process right now. And if you are looking for some help on how to navigate this real estate market or just kind of talk about your own mortgage situation, you could book a call with me using the link that's right here. It's www.chatwithzen.com. Until next time, your move, your future. See ya! Now that you're done watching this one, how about this one or this one? You know what? Just watch them both.